When you have a stock market that is rising, you need to understand why that is. Are the fundamentals good? Is the economy doing well? Are these gains justified? Once you decide that based on actual statistics and not on the mainstream media or government, you can then take the next step. Investigate what exactly is going on at a deeper level. You came here for the truth, so let me unveil that for you. Today, we are going to look at the US stock market and what has been keeping it from crashing. Let's begin with the Willshire 5,000 Total Market Full Cap Index. And what we see with this is a broad analysis of the US stock market. We're not looking at just a few stocks. We can see the whole picture. And it is very clear that it has been increasing year after year with a few bumps along the way. That's all I want to show you with that. Now, looking at the S&P versus the Dow, you will notice that in the past couple months, there has been a chasm which has formed in between the two. Now, what exactly is going on? Well, the Dow Jones has very few stocks compared to the S&P 500. And you'll notice that it has been just a few stocks that have been rising and rising very well, and not the whole market. That's what I'll suggest to you. This has become apparent very recently, but of course it has been going on for quite some time. And that takes me back to the financial crisis, or just before the financial crisis. Before it hit, it was the tech sector which was increasing. So as the different sectors were falling off the grid, nobody wanted to touch housing, nobody wanted to get into construction, building materials, they wanted to stay away from the financials as everything started failing, and it was tech that was carrying the torch. Now, this is just the Apple stock in particular. But essentially what I'm trying to show you is that the market began to narrow. So as these different sectors started falling off, you had investors looking for places to put their money. So that caused a run up in different things, in this case, tech. And it wasn't the tech sector as a whole, it was few select stocks. That's usually the way it works. The big ones tend to get bigger. So this narrowing is a big problem because I see that happening today. Let's get more into that right here. Out of Market Watch, major US stock market indexes are trading near record levels, but does that statistic simply mask an ominous picture that's being painted behind the scenes? Market breadth, a measure of how many stocks are rising versus the number that are dropping, that has turned exceedingly negative. This is what I've been talking about. I never use this term, market breadth, but this is what I've been talking about. And despite this, the market may continue to rise. As long as these stocks continue to go higher and higher and higher, then surely the market could rise. But this is a trend that becomes very dangerous. All right. As the indexes continue to produce a series of higher highs, subsurface conditions are painting an entirely different picture. That's something that I totally agree with. He noted that year-to-date advance in equities, the S&P 500 is up 10% in 2017, has been driven by outsized gains in some of the biggest names. That's right. Because they've increased dramatically, you notice that that's what's really driving the market, most notably the so-called FANG stocks, which refers to a quintet of technology and internet names, have by themselves contributed to more than 28% of the benchmark index gain. So 1/3 essentially, nearly, of the gains are coming from the FANG stocks. That's huge. Add in a few more here and there, and all of a sudden you can see where the gains are coming from. It isn't the market as a whole that is doing well. Yes, you can look at the stock market index and see that it has risen, but break it down stock by stock, you start to paint a different picture. This is what concerns me. It's the market breadth. Yes, the market is going higher, and maybe you have been investing in the stocks that have risen. But what happens when the dominoes fall? You can't stop it. This here is talking about something similar. It's usually not a good sign for there to be a narrowing of the market in a bull market. And this here, it does talk about Hong Kong. It's talking about the market there, but it also gets into the US as well. And essentially, we have a problem globally because of the way that things are done. You have central banks that print up money buying shares. They don't buy the whole market. They buy select stocks. Sure, they might buy 100 different stocks, but they're primarily focusing on a handful. And that really gives an unfair advantage to certain stocks. It very often means that eventually people are going to run out of things to buy. It's very interesting to see it being spoken that way. Let's look at these. The 2017 payout analysis, the 10 largest bank holding companies. And what I'd like to note from this is the approved payout ratio share repurchases. The companies here like JP Morgan and let's see, Citigroup and Goldman and everybody else, all the big boys, they have been repurchasing their own shares, buying shares of their own company at an extreme level. It's a rate that they can't necessarily keep up with, and this has allowed the stocks to continue to rise. All of these programs, the share repurchases, the fact that the market has been rising not as a whole, but on a select few basis, and then you have central banks printing up the currency, all of them sort of interrelated anyway. But this has been one very major reason why companies sitting on cash, what do? They repurchase their own shares. They don't necessarily get into further development. They're worried about the future, perhaps. Perhaps they want their shares to rise, try to collect more investors in there. This is part of the program. And last but not least, the 12-day S&P closing range on a percentage basis, according to this chart, the quietest market in US history. I'll leave that with you. That's all for this video. If you found it informative, please give me a thumbs up. Remember that when you give me a thumbs up, it pushes these videos higher up into the YouTube search ranking. So if you want to see the Money GPS getting higher up there, please give me a thumbs up. If you don't like the video, then share your opinion and give me a thumbs down. And last but not least, if you found the video informative, I know you will find my books, The Money GPS, and my new release, Global Economic Collapse, even more informative. You can flip through the books at Amazon. There's links in the description below. The first book is about the 4 asset classes and how to profit from it. And the new book is about how to reduce your expenses, becoming self-sufficient, solar panels, and other things. So take a look. Links are in the description. Take care.